Imagine a titan, a century-old institution built on integrity and trust, vanishing almost overnight.
Not due to a competitor, not due to market forces, but due to a catastrophic lapse in judgment and a fatal entanglement with one of the most infamous corporate scandals in history. This is the story of Arthur Andersen, once an accounting giant, brought to its knees by the spectacular implosion of Enron. It's a cautionary tale of how the pursuit of profit can corrode even the strongest foundations of ethics and how a single scandal can reshape an entire industry, leaving behind an indelible scar. How did one of the most respected names in global finance become a pariah, reduced to a historical footnote in just a few short months? Our story begins in 1913, in Chicago, when a young, ambitious accountant named Arthur Andersen, alongside Clarence Delaney, founded an accounting firm with a revolutionary principle: integrity above all else. Andersen himself was a staunch advocate for ethical accounting practices, notoriously telling clients, "There is not enough money in the city of Chicago to make us tell a lie." He instilled a corporate philosophy famously known as "think straight, talk straight." This wasn't just a motto, it was the bedrock upon which the firm's reputation was built. In an era when accounting standards were still nascent, Andersen championed transparency and truth, refusing to sign off on dubious financial reports, even if it meant losing clients.
This unwavering commitment to honesty quickly distinguished Arthur Andersen.
The firm grew steadily, attracting top talent and high-profile clients who valued their rigorous approach. By the mid-20th century, Arthur Andersen was a powerhouse, one of the Big Eight accounting firms, renowned for its meticulous audits and unwavering independence. Their reputation for quality and reliability was unparalleled, making them a preferred partner for burgeoning multinational corporations. They were more than just number crunchers, they were trusted advisors, guardians of financial truth. As the economy evolved, so did Arthur Andersen. In the 1970s and 80s, the firm aggressively expanded into consulting services, a lucrative new frontier.
This diversification brought immense profits, transforming the traditional auditing firm into a global professional services behemoth.
By the late 1990s, Arthur Andersen had become one of the Big Five, a truly international giant with a presence in over 80 countries, employing tens of thousands of professionals, and generating billions in revenue. They were at the pinnacle of their industry, seemingly invincible. Yet, the seeds of their destruction were already being sown, hidden within the very success that propelled them forward. The sheer profitability of consulting began to overshadow the slower, less glamorous work of auditing.
A quiet internal struggle emerged: should the firm prioritize its traditional role as an independent financial watchdog, or chase the exploding profits of its consulting arm? This internal conflict, between audit independence and consulting revenue, would prove to be their undoing.
The turning point for Arthur Andersen arrived in the form of a meteoric energy trading company based in Houston, Texas, Enron.
Enron, led by charismatic figures like Ken Lay and Jeff Skilling, was hailed as an innovator, a company that could seemingly do no wrong. Their stock price soared, their executives became billionaires, and the financial world celebrated their unprecedented growth.
Arthur Andersen had been Enron's auditor for years, practically since its inception, fostering a relationship that extended far beyond simple auditing.
Andersen not only audited Enron's books but also provided a wide array of highly profitable consulting services.
This dual role created an insidious conflict of interest. The millions of dollars in consulting fees flowing from Enron to Andersen year after year created an almost irresistible pressure to maintain the relationship at any cost. As Enron's financial maneuvers became increasingly complex and questionable, internal red flags began to appear within Arthur Andersen. Junior auditors and even some senior partners raised concerns about Enron's aggressive accounting practices, particularly its use of special-purpose entities, or SPEs, which were essentially off-balance sheet vehicles designed to hide debt and inflate earnings. These structures were technically legal, but Enron exploited them to such an extreme that they fundamentally distorted the company's financial health. When concerns were brought to the highest levels at Arthur Andersen, the instinct to protect the lucrative client relationship often prevailed over the ethical imperative of think straight, talk straight.
Whistleblowers within Andersen who dared to challenge Enron's books were often sidelined or even removed from the engagement.
The pressure to keep Enron happy and retain its business became paramount, slowly but surely eroding the firm's century-old commitment to independent oversight. The house of cards began to tumble in 2001.
Enron's elaborate financial deceptions could no longer be contained. As cracks appeared in its fabricated success, the company's stock plummeted, wiping out billions in shareholder value. What followed was a public unraveling of corporate deceit on an unprecedented scale. As investigations mounted, the spotlight turned sharply on Arthur Andersen.
It became clear that Andersen's role went beyond mere negligence; they were actively complicit. Evidence emerged of widespread document destruction at Andersen's Houston office, with employees allegedly shredding tons of Enron-related documents to conceal their involvement. Emails and internal memos surfaced, showing that Andersen partners knew about Enron's problematic accounting and, in some cases, even helped design the very SPEs that hid Enron's debt. The Department of Justice launched a criminal investigation, and in March 2002, Arthur Andersen was indicted for obstruction of justice. The charge was that they had knowingly destroyed documents relevant to an SEC investigation. The indictment was a death blow. Clients, facing public scrutiny and eager to distance themselves from the scandal, abandoned Arthur Andersen in droves. Partners and employees, fearing for their careers and the firm's future, defected to rival firms. Within weeks, what had been a global powerhouse was reduced to a shell of its former self. Despite a subsequent Supreme Court decision in 2005 that unanimously overturned the conviction, finding that the jury instructions in the original trial were too broad, it was too late. The damage was irreversible. The firm had already dissolved, its name irrevocably stained, its reputation shattered beyond repair. From a global titan, Arthur Andersen was reduced to a historical cautionary tale, virtually ceasing to exist as a functioning entity. The fall of Arthur Andersen sent shockwaves throughout the global financial system. It was a stark, brutal reminder of the critical importance of auditor independence and integrity. The immediate aftermath saw the rapid dissolution of one of the Big Five accounting firms, leaving only 4 major players. But its legacy extends far beyond that. The Enron scandal, with Arthur Andersen's central role, catalyzed sweeping legislative reforms. In 2002, the U.S. Congress passed the Sarbanes-Oxley Act, or SOX, which dramatically reformed corporate governance and accounting practices. SOX mandated stricter oversight of auditors, required companies to establish internal control structures, and increased penalties for corporate fraud. It fundamentally changed how public companies are audited and how their financial health is reported. The story of Arthur Andersen serves as an enduring lesson. It teaches us that even the most established institutions, built on the strongest ethical foundations, can crumble under the pressure of compromised principles. It highlights the insidious danger of conflicts of interest and the critical need for independent oversight in safeguarding the integrity of financial markets. It's a testament to the idea that a company's most valuable asset is not its revenue, but its reputation and its adherence to ethical conduct. The ghost of Arthur Andersen remains a powerful reminder that integrity, once lost, is almost impossible to regain, and the consequences of its abandonment can be catastrophic. If you found this deep dive into corporate history both fascinating and sobering, please take a moment to hit that like button. It helps us bring more untold stories to light. And if you don't want to miss our next exploration of the giants and Goliaths of industry, be sure to subscribe to the channel and ring that notification bell. We love hearing your thoughts, so leave a comment below and tell us what you think was the biggest takeaway from Arthur Andersen's dramatic downfall. Thanks for watching, and we'll see you in the next one.